Let's get you an analyst view as well. Mayuresh Joshi, fund manager at Angel, joins us. Mayuresh, thanks for joining us. You're, of course, here on Bottomline to talk about your picks and your budget expectations. But I'm going to throw in a question on the MIP in steel. And we've heard three different players react differently to this news. What's your take on this in terms of an impact on the steel companies?
Morning, Minnie. I think clearly, I think a large part of the MIP increase that was expected to come through was expected by the markets. It was just the quantum that the markets got a little bit surprised about. But let's get to the facts. I think you are already having some excess inventory when it's coming down to the steel products, whether that's crude steel production or the finished products, at least in the first half of FY16. Secondly, I think the utilization levels that a lot of these steel companies are operating at currently are again operating at not levels that you're probably used to in bull market. So clearly, I think there is lackluster demand that is probably coming through. Third, I think the step was necessary because I think if you look at the kind of pressure points that a lot of these steel companies were going through, I think that was very, very evident on their balance sheets along with the leverage that they were probably carrying. So I think fall in realizations, what probably happens with the dollar-rupee parity, I think these were all the important things to be probably watched out for. So clearly, I think it's a relief for a lot of these steel makers. What probably happens is the differentiation between the larger and the smaller players and the players who get impacted with the inclusion of MIP. So I think the HRC players, the flat product manufacturers are going to clearly get benefited over the longer time horizon. However, I think in my opinion, clearly I think the smaller players are still going to face a lot of issues when it comes to their interest coverage because a lot of these guys are not even making profits at the EBITDA level. So I think the operating profits itself are very, very minuscule. So I think some respite thereof in the coming numbers over the next few quarters and how the market demand shapes up is going to be a key parameter. So clearly, I think a sentimental impact for players like JSW Steel, Tata Steel, but clearly I think the long-term benefits should be seen over the next couple of quarters once demand probably revives and you probably see some amount of respite coming through in terms of realizations on the domestic front.
For now, the sentimental impact is good enough, Mayuresh, given that sentiment over here was so weak because of the negativity. But that's the focus on steel and the MIP news. But we will head into a short break. We'll come back after the break and ask Mayuresh what his biggest bets are in these volatile markets and what he expects from the finance minister this budget. Stay tuned. Welcome back. You're watching Bottomline. A quick heads up. Precision camshafts made a disappointing debut on the bourses today. It opened down very sharply, down almost 10%, but it is now down about 1.7%. My colleague Shilpa caught up with Yatin Shah, CMD of the company, and began by asking him how the company plans to grow in a volatile environment as well as their fund utilization plans.
I think I'm very convinced about the fundamentals of the company. So we entered the markets in challenging times or in volatile conditions, but I'm very sure about the fundamentals of the company. They're not for short term, they're here for the long term. So I believe we see pretty good times to come.
So if you could run us through the proceeds from the IPO, what are you looking to use them for?
Primarily the purpose of these funds is to create a machine shop. This machine shop is going to be created for an order from a global customer. So the entire proceeds are going for creating a capacity against contracted demand. It's not speculative. It's going against something that has already been received as an order. Okay.
And if you could tell us what is your debt standing at currently, and going forward, how do you see how can we see you retiring your debt?
Well, the debt is really not that much on the board.
Okay.
I think we are in the range of about 30-35 crores, which is not really substantial. So I don't think that's a cause of concern. I mean, I guess we should have retired the debt by the end of the year.
And majority of your revenues come from exports. Going forward, is it going to continue to be like that, or do you see it changing in any way with the domestic, your domestic business contributing a little more?
No, I think going forward, the ratio would continue to stay the same. We're at about 75-76% exports and about 24% domestic. Going forward, there's a lot of focus on exports. So I would believe that the ratio would continue to be in the same range as we now are in.
And if you can run us through what your EBITDA margins are currently going forward, do you see them being sustainable?
Yes, I think we are at about an EBITDA between 29-30%. We believe that this is a sustainable model. We've taken a lot of measures to ensure that we sustain these as we move forward with increasing capacity.
Right, that's the management speaking on the debut, but let's get back to the markets. Mayuresh Joshi, fund manager at Angel Broking, still with us. Mayuresh, I'm going to ask you, normally in the run-up to the budget, you do see the markets, factoring in a lot of expectations and moving up. We've started this year on a very dismal note because of the global volatility and the rout in the commodity space. Do you see the dust settling, and what is your own call on the markets and expectations from the budget this time round?
No, clearly, Mini, I think the volatility in the markets is going to continue. And again, I think what the RBI governor has done has thrown the ball in the exchequer's court. And typically, I think what is now going to be a dilemma is going to be whether fiscal consolidation is on the cards or is he going to loosen the strings on that one. So clearly, I think the markets want more spending to probably come through in terms of the non-planned capital expenditure. At the same time, probably he also has to keep a watchful eye on how he consolidates on the fiscal part, because clearly I think a loosening on the fiscal deficit, a lot of economists will argue that it will probably fuel inflation going forward. So clearly I think these two parameters need to be balanced by the exchequer, but clearly I think non-capital expenditure is something that I would ideally look out for, the figures that the exchequer probably gives, because that is going to be a huge booster in terms of how spending will happen, at least from the government side. And we all know, I think, once government capex starts happening, I think the private capex follows with a lag effect. So clearly I think once the government capex, which is already happening at the current juncture, increases by some proportion in magnitude, you will probably start seeing private capex follow through, which is essential and which is what really one expects over the next few quarters. Secondly, probably I think what the exchequer probably does in terms of recapitalization, which is already mentioned in terms of what will probably come through, and those figures are probably more public at this point of time, but what he specifically mentions is going to be key. What probably happens with a lot of these block projects, specifically on the infrastructure part, the EPC part, the power segment, I think these are incentives that the markets will probably look out for to probably have a booster dose specifically for the infrastructure stroke construction sector. So in a nutshell, probably I think he has to balance a lot of things. There are a lot of expectations laid out by various industries, but I think he'll have to do a fine balancing act in this budget.
In terms of sheer prospects at this time, because we are on the cusp of a recovery, the window of that recovery is being expanded and extended. Today we have GDP numbers, and it's not going to be a pretty picture for the third quarter. What are the 3-4 sectors and stocks that you think are ready for an upsurge from these levels? What would your top picks be, and what are the themes? I mean, let's start off with a thematic piece of what your hypothesis is based on.
Absolutely. So again, clearly I think when you're probably seeing the banking sector, specifically on the larger private side, beaten down, I think the valuations have become extremely attractive. Now, people who were chasing these stocks at 1.7, 1.8 times price to book, I think a lot of stocks have come down to 1.1, 1.2 price to book. And a lot of people are now feeling distress in terms of how asset quality will pan out. It was a known fact that a lot of the corporate exposures that a few of the larger private sector banks had would be under stress. And again, the provisioning would cause a dent in terms of how the asset quality would pan out. So clearly valuations have become extremely attractive for the larger private sector bank as a fund. So I think larger private sector banks is something from a thematic perspective is what we like. Cement as a theme, Mini, is something that we're probably very, very optimistic about at this point of time. Yes, again, it's a little bit on the optimistic front related to how earnings will pan out, and again expectations of the capex cycle probably turning sooner rather than later, which is going to fuel the utilization levels, the volume growth, and probably create some amount of impact as far as realizations are concerned. But clearly I think the government focus on infrastructure, housing is going to pay off in the next few quarters. And again, I think with a couple of time horizon, probably cement companies, specifically the larger ones and a few mid caps, I think look attractively priced and placed at this point of time. So cement is a theme that we'll probably like. Large cap IT, clearly I think NASSCOM, though they have lowered their guidance, our own take is that in constant currency terms, a lot of the large cap IT players will do well. The valuations have probably contracted as the earnings probably have panned out over the last.
We will have to button over there. We seem to have some audio disturbance with that line. But yes, cement is an interesting theme because we've also seen a bit of consolidation over there with what's happened with Reliance Infra and Birla Corp as well, indicating some kind of an up move. Mayuresh, sorry about that. We had a problem with your link. But yes, cement, just picking out on that you picked up. cement does seem to be seeing some bit of a revival. We're seeing deals, and that's normally the first sign that industrialists are looking at visibility of demand picking up. How do you see that piece panning out, and what are the valuations looking like over there?
No, clearly, again, I think you have to, again, sort out the larger ones and the mid-cap ones. So the mid-cap companies typically trade or are valued in the range of around 50 to 70 odd dollars on an EV to ton basis. The larger ones, anywhere between 140 to 190, in fact, Chile cement even higher than that. But clearly, I think, A, you must probably look at the pan-India presence. B, I think the kind of impact that these companies can make once the demand revival happens. So I think it's an entire theme based on how the demand revival will happen, which in turn will affect their volumes. And once the volume growth pickup starts happening, you'll automatically see realizations stabilizing and improving thereafter, which will effectively give a spur to their return ratios. So clearly, I think utilization levels across the industry at the current juncture are still languishing around 70-72%. But clearly, it's the expectations of demand revival which is going to push up the sector. So again, I think on the larger ones, something like an Ultratech, for example, I think it's trading at a premium of around $170 on an EV to ton basis. But would that premium justification work over the next 2 to 3 years? Oh, absolutely, because if you look at the capacity of around 71.8 MTP expected by 517, along with the merger of JP's plants that it has taken, you're probably looking at a pan-India player who's probably got access to key markets. So clearly, I think cement as a theme, plus expectations of earnings revival happening on the next few quarters, is something that we like at this juncture.
Right. Apart from cement, what are the other themes that are working out? There was a little bit of interest in the automobile sector, especially after segments, first the heavy commercial vehicles and then the passenger car segment started going up. But recently it has come under a cloud, and I'm presuming that the MIP news is going to start hurting a lot of the automobile companies because they're the user companies. How do you see that space?
No, clearly, I think one really needs to be stock selective within the space itself, and really you need to again differentiate between what you're probably buying. Are you buying four-wheelers, are you buying two-wheelers, or are you buying the auto ancillary makers? So clearly, I think the auto ancillary makers are not dependent on how the OEM players are probably doing, whether they are four-wheelers or two-wheelers. But clearly, if you look at companies which have been growing well, where the earnings visibility is still very evident from the numbers, I think we'll be looking at these players. So clearly, within the four-wheelers, I think Tata Motors has corrected meaningfully in our opinion, and clearly, I think the kind of bad news or the spate of bad news that one really expects from China is largely in the price. So I think the numbers might be under pressure, but with new platforms probably coming through for Tata Motors, and ex-China sales, specifically the North American markets, are holding up pretty well. Similarly, I think on the two-wheeler side, our own take is that TVS Motors looks attractively placed at this point of time. New launches coming through, management extremely confident of regaining market share close to 15-16 odd %. And valuations also not looking that expensive at the current juncture. Within the auto ancillary part, I think something like an Amara Raja Batteries, which in my opinion has posted an excellent set of numbers, that earnings visibility and momentum should continue in our opinion.
What are the top mid-cap themes that you like, or stocks that you like specifically?
So again, I think as a disclaimer, I think all the stocks we're probably discussing, many we might have discussed with our clients and we may be holding in our PM schemes. In the mid-cap universe, probably with the numbers that we've probably witnessed so far, Jagran Prakashan is something that we like. Yes, the radio business probably contributed to the ad revenue sales for the company for this quarter, but clearly I think the radio business has very reasonable margins going forward. And even on the print business, I think the circulation business has done reasonably better. The ad revenue is expected to still grow in higher double digits. So clearly Jagran Prakashan is something we're liking. United Phosphorus, the numbers were exceedingly good in our opinion. Global agrochemical player, integrated completely. You've got presence across continents. You're probably looking at $3 to $4 billion over the next 3 to 4 years going off patent, which probably benefits a player like UPL. It's a high entry barrier business, and it trades at 11.5 times, which we believe is quite reasonable considering the kind of business model that the company probably operates out of.
Okay, so United Phosphorus and Jagran Prakashan are the top mid-cap picks from Angel and Mayuresh. Mayuresh, always great talking to you. Thank you so much for joining us today. With that, it's a wrap on Bottom Line. Thank you for watching. We'll be back with all the top stories on the other side. Goodbye.